Welcome to a presentation on international finance and the impact and effect of COVID-19. It's presented by myself, John McCulloch, and in today's presentation we will cover the following topics and critically analyse them. They are the Marshall-Lerner condition, Dornbusch exchange rate overshooting model, purchasing power parity, foreign exchange risk option and futures, the role of financial institutions, and a small conclusion. The COVID-19 pandemic has had a great impact across the globe, with virtually every aspect of life being disrupted. According to the Office of National Statistics, the pandemic is expected to have a greater impact on the global economy than the 2008 financial crisis. Due to the many lockdowns in the majority of countries, virtually all trades either ceased or slowed down, causing businesses to close, either temporarily or even for good. This has had an adverse effect on the trading markets. According to the accountancy firm PricewaterhouseCoopers, the British pound sterling fell 15% against the US dollar since the start of the pandemic. There has been an increase in pressure for financial institutions to aid businesses and customers from the economic uncertainty. However, the true impact of the virus is still yet unknown. Due to COVID-19, the global GDP is expected to decline, with developed countries expected to decline by 7% and undeveloped countries expected to decline by 2.5%. COVID-19 caused global trade to shrink by 13% in 2020. This is a larger increase than in World War II. Due to the lockdowns and business restrictions around the world, trade has fell and manufacturing sectors had ceased. This has in turn led to the global fall in import of raw materials, oil and machinery. Many developing countries will participate in a currency devaluation in order to improve their trade account. They'll do this by making their exported goods cheaper and in turn improving their trade account. The goal is to make the sum of elasticities greater than 1. This is known as the Marshall-Lerner condition. If exports are in decline, a country will change the prices accordingly to increase exports. This, however, causes the goods that stay in the country to become more expensive and exacerbates the trade balance. This causes a price elasticity problem. For a developing country, devaluing their currency could lead to an increase in COVID-related imports such as PPE or hand sanitizer. This has the potential to improve the overall happiness of the developing country, as they will see a steady flow or increase in business. However, selling goods at a cheaper price can have its effects. It can lead to worker exploitation as prices rise for the developing country and fall for other countries. With people already anxious surrounding the current pandemic, this has the potential to cause riots and civil unrest between public and government. Rudi Dornbusch is a well-known German economist who was the author of the 1976 overshooting model hypothesis. The importance of this model is to explain the high levels of exchange rate volatility. The main feature of the model is to establish a relationship between sticky prices and volatile exchange rates. The main thesis is that the prices of goods in an economy do not immediately react to a change in the foreign exchange rates. Instead, the domino effect encompasses other factors such as the financial markets, money markets, derivative markets, and bond markets. Foreign exchange markets overreact to changes in monetary policy, which creates equilibrium. In the short run, changes in the money supply affect domestic interest rates. If there is an increase in the money supply, this could lead to causing the domestic rate to over-depreciate, lower the rate of return for domestic deposits, and lower the domestic interest rate. In the long run, changes in the money supply are matched by proportional change in price and don't affect the real income or interest rates. Exchange rates are influenced by interest rates and expectations. These can change quickly, thus making exchange rates more volatile. Volatile exchange rates make international investment decisions more difficult. Since the COVID-19 outbreak, many central banks have tried to minimise the impact of the outbreak by adjusting the monetary frameworks. The impact of COVID-19 varies among different currencies based on a number of factors, such as their market standing, risk sensitivities, and the government policy response. With uncertainty of Brexit and COVID-19 pandemic, the UK pound remains weak. Many countries' exchange rates have been affected due to COVID-19. It's useful to see from the Dornbusch overshooting model to explain the volatility of the exchange rates. Purchasing power parity, or PPP, is the idea that a unit of currency can buy the same item in one country as the equivalent amount of foreign currency can buy in a foreign country. If there are discrepancies in the PPP, it can be gauged by comparing the price of two identical products in two different countries. One example of this is comparing a McDonald's Big Mac. You would compare the item in a common currency such as the US dollar at the current market exchange rate and use that to see if a country is over or undervaluing the item relative to the dollar. Since goods are meant to be placed at the same cost in different countries, This means exchange rates must be adjusted to make prices equal. However, this isn't a great reflection on reality. In the short run, PPP might not be a reliable indicator. Short-run deviations from PPP are large and volatile. The volatility of short-term PPP comes from the frictions in international goods markets such as transport costs, tariffs, information costs, or lack of labour mobility. It could be argued that PPP is not the most useful way of predicting movement in the foreign exchange rates in the short run. COVID-19 will have made this even more of a challenge. Businesses closing and economies failing, the volatility of short-run PPP will be even more evident. While PPP is not particularly good at predicting the short term, it can be argued it is better in the long term. It is estimated that deviations from PPP have a half-life of approximately 4 years for exchange rates. Estimates suggest that these deviations might die off at around 15% per year. It does not, however, take into consideration that there are price rigidities that could potentially make price adjustments very slow. PPP holds better in the long term, incited by real economic events such as government policy or changing in taste. It may take a while to understand if COVID-19 has put a spin on things, since long-term PPE requires a long time to work out and COVID-19 has only been around for a short time. The full impact of the virus on global trading of futures and options is not yet fully known. However, several trends have emerged. The closing of trading floors and working to keep the market open are amongst the trends so far. Travel restrictions, business cessation orders, and national lockdowns have had their impact. Currency exchange is one of the largest risks a business can face. Due to the impact of COVID-19, businesses are realising there's a hidden danger to not managing currency exchange risk. Futures and options are two types of derivative contracts. Derivatives are securities that derive their value from underlying asset or benchmark. They can be used for speculative purposes or hedging. Derivatives can be based on a variety of items, including commodities, derivative transactions documented under 2002 ISDA Master Agreement. Hedging involves reducing or eliminating financial risk by passing that risk on to someone else. Future contracts are an agreement between two parties for the purchase and delivery of an asset at an agreed price at a future date. They are traded in exchanges and are for standardised amounts and have a standardised maturity dates. A currency option, also known as a forex option, is a contract that gives the buyer the right, but not the obligation, to buy or sell a certain currency at a specified exchange rate on or before a specified date. Despite the uncertainty caused by the pandemic, these markets have continued to be extremely important functions of price discovery and risk management without interruption. There are many different financial institutions, from central banks to insurance companies, who protect businesses and individual customers against financial loss. These services are even more critical during the current pandemic. It is vital they work together to ensure minimal loss to its consumers. Bank of England put in place a collection of measures to protect the economy after the pandemic, such as cutting their interest rates to 0.1% and offering funding to commercial banks at a similar rate. However, despite these measures, many businesses have permanently closed, mostly in the hospitality industry, and branches have changed stores, while other firms will not reopen until 2021. Several insurance companies either adjusted or extended their cover to aid their customers. Viva offered both free breakdown cover and a free courtesy car for NHS workers, as well as enhanced personal belongings cover for any damage suffered to their belongings. In the United States, two firms, Allstate and American Family Mutual, offered their customers refunds as a result of reduced road traffic, therefore reduced the number of accidents as a result of the lockdown. During the pandemic, businesses may have to adapt by using risk management techniques. There have been various closures of high street retailers since the pandemic, with companies such as Edinburgh Wool and Mill, Pret a Manger and Debenhams closing their stores across the UK. Many online businesses have benefited from the pandemic, such as Amazon and Boohoo, who have seen an increase in sales. This increase in the online market has led to increasing competition. While some financial institutions have made a move to protect businesses and consumers, it may have been too slow to offer aid or no aid at all. Despite the furlough scheme, there have been almost 500,000 redundancies in the UK. In conclusion, it can be seen that the financial institutions on a broad scheme have handled the pandemic poorly. Many redundancies have happened despite the furlough scheme. This is having a great effect on the global economy and financial markets. Only time will tell whether the real extent of COVID-19 has impacted the planet. While there has been a sharp decrease, it could bounce back quickly due to the unforeseen nature of events. Thank you for watching our small presentation on the impact of COVID-19 on international finance.